Market is doing terrific today. The Dow Jones Industrial Average is up 291 points right now. It's been such a rough year for the market so far. It's hard to find anybody suggesting investors move back into this roiling stock market.
However, our next guest suggests may at least be time to dip your toes in the equity ocean, although specific equities. He's Alec Young, equity analyst for S&P, the company that just upped its rating of U.S. equities from underweight to neutral. Hi, Alec.
Hi, nice to be with you.
What is it about U.S., I believe it's large cap equities you like right now? What is it about those that you say makes it time that they're a little bit more attractive at the moment?
Yeah, a few days ago we moved to neutral from our underweight view on the U.S. market, which had been in place for a couple of months. We think valuations have gotten pretty compelling, and although we continue to get buffeted by bad news out of the credit markets, today's news with the Fed being willing to step in and exchange treasuries for a lot of the more illiquid credit securities, asset-backed securities with broker-dealers, we think that's really good news on the credit front. So we've got a decent equity rally going here. So we think there's reason to get a little more constructive on U.S. stocks here.
Alec, are you at all concerned that some of the bad credit on the bank's books is now being moved over to the Federal Reserve because they're taking as collateral a lot of the subprime mess that nobody else wants? The taxpayer essentially now owns it.
Sure. I mean, that's definitely an interesting question, and I think that that's going to get probed more in the days and weeks ahead. But for equity investors, their main concern was the fact that it was on the books of publicly traded companies. And so, obviously, that had a more negative impact from a stock market perspective than shifting that risk more over to the Fed. But certainly, the Fed, while they're certainly in a stronger financial position than a lot of private companies, they can't take, an unquantifiable amount of risk. So that's something that we'll have to look at more closely. But right now, we're just glad that they've stepped up and provided a much-needed relief valve in the credit markets.
Well, Alec, though, we're not trying to tell people, I believe your message is not to be a blind dog in a meat house and just start eating everything. Specify it if you could. What do you like right now in particular?
Well, all year we've been more focused on defensive areas, things like consumer staples, things that people are going to need whether we go into recession or not. Thankfully, we've been staying clear of financial companies, tech companies. We pretty much continue to recommend a pretty cautious outlook at the sector level. We think there's reason to believe that the risk reward is getting better overall, but we're certainly not out of the credit woods. We'd like to hear specifics from some of the impacted companies, the big investment banks, the money center banks.
So would we.
Letting us know that in fact this new Fed action is going to have a materially positive impact on their outlooks before we get a bit more aggressive on the more cyclical areas of the market.
All right, let's bring our panel in here. And Peter, what do you like at this moment?
Well, I like the foreign markets. I like the commodities. I mean, I haven't just been underweight in the U.S. I've been zero weighting the U.S., and I've been doing that for years. I mean, I got a couple of oil and mining stocks here, but in general, you want to underweight dollar-denominated investments and overweight everything else. So you want to invest abroad. You want to invest in the companies that are going to profit from the growing purchasing power of foreigners, not the diminishing purchasing power of Americans. And, when you invest abroad, you get much lower PEs, you get much higher dividend yields, and you get dividends in currencies that are going up.
So, Alec, can you respond to that end? Do you agree with anything Peter says? I mean, counter that.
Sure, to a certain extent. I really don't agree with it this year. I mean, one thing we've seen is after several years of strong outperformance of the U.S. by the international markets, both developed and emerging, they've really tanked this year. They've been able to weather a bit of slowing in the U.S., but with the U.S. heading into recession, people have really run for the hills in European stocks, Japanese, even in the emerging markets. I mean, they've decoupled to a certain extent, but if the U.S. economy really starts nosediving into recession, I think it's naive to think that you can make a ton of money in overseas stocks.
Well, it's not naive. I'm actually doing it. I mean, I think if you look at the emerging markets, and I would agree that some of those stocks went ballistic, and so those have come down quite a bit. But I can look at my own client accounts. If you look at the conservative, yield-oriented stocks that we own around the world, they're actually doing still pretty good. They're outperforming the U.S.
And Terry, you got to. I always like to buy American whenever I can, but when you look at the value of the dollar plummeting and you don't see any end in sight, at least in the near term, you wonder whether maybe Peter's right on that.
Yeah, I mean, you want to get paid in those foreign currencies. You want your dividends in those foreign currencies. Repatriate them back into dollars because the dollar is being devalued by the day. And, a lot of people say we see the end in sight, but they said that at the end of last year. This was supposed to be the year of the dollar. And with the Fed dumping $200 billion, every Tuesday on the market, I don't think that the dollar is really going to rally. And I find it hard to make a case for the U.S. market overall. I think it's oversold. We were down 17% from the highs as of yesterday, but you have the financial sector in the dumps, you have the housing and housing-related sector in the dumps, you have the consumer in the dumps, tech. That's 75% of the market.
Victoria Barrett, do you see Alec's side of this? Because everyone's ganging up on Alec.
Well, here's the thing to remember. When you're investing, you're thinking about future earnings. And at some point, we look out and we see, much healthier earnings. I'm not calling a bottom. If I were to call a bottom, I'd be running a hedge fund. But at some point, U.S. earnings will reach a point where and valuations have come down pretty far, that U.S. big equities are going to be a great investment.
All right, Gary, we haven't forgotten about you, but we're up against a hard break. We'll get you in.